As the stock market starts to sell off for several months and starts to sell down, I think we could see gold continue to push higher. Eventually, as you just said, Danny, this is exactly what we see when real fear in a bear market actually starts and we start to get a massive breakdown in the stock market. It actually started over here. When it starts to sell off, gold will get pulled down with it. But gold only pulled back about 34%, whereas the stock market pulled back, 55, 54%. So, and then eventually gold will shoot up and take off. And I think that's going to be the next major bull market for gold miners. And I'll be really excited. But right now, we just need to let the stock market see if it's going to put in a top. And at this point, gold, you should be long gold. If you hold it physically, you should be happy. It's a good chart pattern. I do think we're going to go to about $37.50 an ounce. So I do like silver and gold. I like both of them. It is pointing to about $38+ per ounce to the upside, maybe even higher than that.
Gold is performing well, and a bullish chart pattern indicates that there is still more upside potential. Similar to previous bear markets, gold is expected to initially decline modestly before rising as fear sets in as the stock market begins a protracted sell-off. According to speaker Chris Vermeulen, gold may spike in value over the next 3 to 4 weeks, possibly reaching $3,750 an ounce. Technical signals suggest that silver is also poised for bullishness and may reach $38 or higher per ounce. Gold is following a pattern akin to previous pre-crash periods where it consolidates while the stock market peaks. According to Chris Vermeulen, a seasoned technical analyst, trader, and founder of thetechnicaltraders.com, gold may experience a modest decline if stocks start a multi-month sell-off, but it should eventually rise. Gold has historically been a safer asset during downturns due to its lower volatility and risk. The stock market might be preparing for a fake-out surge, in which prices reach all-time highs but swiftly fall back. To determine if this is a genuine breakout or merely a prelude to a more significant correction, we'll have to wait a month or two. Similar to previous market peaks, the current stock market is exhibiting symptoms of short-term euphoria, with investors feeling elated and unduly hopeful. Particularly when consumers buy at highs, this emotional stage often precedes abrupt corrections. Gold, meanwhile, continues to display a robust bullish chart pattern, indicating that higher prices are likely in the future. The scenario is identical to that of the 2007 and 2008 market, with gold rising gradually and stocks reaching nominal highs. In those days, gold soared as the market plummeted by 55%. According to analysts, we may be in a similar cycle right now, with gold expected to rise when stocks start to decline. Recently, gold miners have begun to outperform the gold market, a trend that frequently signals an impending gold boom. There is a warning, though, as miners underperformed during the 2007 and 2008 crisis, despite the rise in gold because they are still equities and get pulled down in a broader market sell-off. Physical gold remains the safer option due to its stable pattern and reduced volatility, despite miners currently performing well. In this volatile market, miners are generally favored over actual gold and silver. We're about to explore the video, but first, subscribe and hit the bell icon to stay up to date with our latest uploads. Your feedback in the comments is always appreciated.
Right now, we're kind of like, gold is kind of in this scenario right here. Whoops, let me just zoom out a bit. I know this is probably hard on your viewers' eyes, but gold is in this scenario, I think, very similar to here. And as the stock market starts to sell off for several months and starts to sell down, I think we could see gold continue to push higher. Eventually, as you just said, Danny, this is exactly what we see when real fear in a bear market actually starts and we start to get a massive breakdown. In the stock market, it actually started over here. When it starts to sell off, gold will get pulled down with it. But gold only pulled back about 34%, whereas the stock market pulled back, 55, 54%. So gold is definitely lower volatility, doesn't carry as much risk. And then eventually gold will shoot up and take off. And I think that's going to be the next major bull market for gold miners. And I'll be really excited. But right now, we just need to let the stock market see if it's going to put in a top. If it does, let it correct and take advantage of the correction. And at this point, gold, you should be long gold. If you hold it physically, you should be happy. It's a good chart pattern. I do think we're going to go to about $37.50 an ounce. And then from there, we'll see where the markets are. I would think over the next month, I'd say the next 3-4 weeks, we could see gold break out and push higher. The market always has a way to drag things out longer than you anticipate. But as you mentioned before, these consolidations are all roughly the same, 3-4 months. Here we are 1, 2, 3 months. So another month or so, it could break out and be running higher. And that goes in line with kind of the monthly chart that we see the stock market poke on a monthly chart to a new all-time high. And then by the end of the month or the following month, we have a big red bar with the stock market selling back down and reversing. And so that coincides. I'd say 1 to 2 months, gold could have this push up and rally to the upside, and the stock market might put in this fake out. It's like the big question is the stock market having a breakout or a fake out? And we're not really going to know probably until a monthly close or 2 months from now. You need to see how the monthly bar closes and how the following one closes. So we have to just stick with the trend at this point. So this is the emotions of market participants, and kind of where we are right now is kind of this thrilling euphoric phase in the stock market in terms of just on a short-term basis. Just over the past week or two, we're getting this kind of thrill euphoric phase among investors, thinking that, we're starting something big and they're going to be rich and they're going to make a ton of money. And that's what you just described as this phase right here. And then it usually abrupts with a sharp sell-off. And then, we could go into a bigger correction. But that's where we are on a short-term basis, is this short-term euphoric phase of everybody piling in to the growth stuff. And it usually doesn't end well for those who, are buying at the highs. It generally hurts because the market corrects and scares them over the next couple of weeks and usually shakes them out.
Anything we can surmise from the price of gold and silver, the precious metals?
Yeah, there's actually an interesting chart pattern here for, gold is definitely still in a very strong chart pattern. We hit a major target over here that had a consolidation. We actually hit another one over here using Fibonacci levels, and we hit another one over here. We've had multiple of these. This is signature bullish pattern. It is pointing to higher gold pricing. And actually, there's a really interesting comparison chart here of the S&P 500 and gold. And actually, if we go back to the 2007, 2008 market top, this is what's really kind of interesting here is, now, if we were to take a look, so this is the 2007 major market top before we went into a huge crash. And so where we could be right now is if we were to look, this is the weekly chart, the candlesticks is the S&P 500, the yellow gold line is the price of gold. If we kind of look at where we are right now on the right, which is today, and this is 2008 on the left, we see gold moving up, and we saw the stock market hit this nominal new high. And right after that, gold continued to sell up as the stock market actually got rejected. And eventually the stock market sold off and went into a 55% correction. And so I think we're in something very similar right now, whereas we've come up, we're hitting this nominal new high. We need to see how this weekly chart or the next couple bars play out. But we can very easily see the stock index push up and then eventually start a big sell-off. And as that fear hits the market, gold should have that next push higher. So we're in a very similar scenario as kind of this nominal new high and gold shooting up in that market scenario. So that's something I'm keeping my eyes on because the sentiment is very similar to what we had in 2007. It's always a different situation, but the charts and the sentiment and the momentum is similar. They've been actually outperforming, which is a good sign. If gold miners outperform gold, it usually means gold's going to rally and break out. So we have been seeing gold miners. It's not a very smooth ride, but it has been trending higher. It's been consolidating. It's pointing to another push and run. My only fear with miners, and we saw this in 2007, 2008, is yes, miners should do well, but what happened before was the best opportunity was actually in gold, boring, pet rock gold, because when the stock market starts to sell off and roll over, gold miners are a stock and they're stuck in the stock market. And the stock market is like the ocean tide. When the tide goes down, all boats go down. Well, when the stock market tide is going down, even though gold might be going higher and the bullish case for miners is really good, they're stuck in a tide that is constantly pulling. So we actually saw in 2007, 2008, there was a small window where gold rallied like 5 or 8%, and miners actually ended up not gaining anything. And so just because they're more volatile doesn't mean actually they're going to be a better play. They are holding up better right now, but I still like gold. It has the best chart pattern. It's the most consistent. And to me, it has the highest probability of making money. So I wouldn't jump ship to miners, although that's what everybody seems to have done. But big old boring gold is kind of like, just want to make some easy money with low volatility. Gold is the play. And I'd be happy with gains, not trying to like swing for the fences in this type of market environment. Silver is similar to gold miners. It's actually really caught up to gold and outperformed. It has a bullish chart pattern. Silver, again, is a commodity, so it won't have the same draw as the stock market goes down. So we got a bull flag pattern. We've got another rally, bull flag pattern. It's holding up. So I do like silver and gold. I like both of them. It is pointing to about $38 plus per ounce to the upside. Maybe even higher than that. And so silver, I like the commodity space better than the miners themselves at this point.
Additionally, Chris Vermeulen notes that due to tariffs and geopolitical concerns, the U.S. dollar has recently become one of the most despised assets worldwide. It is currently oversold and in decline, but it remains within a long-term, erratic ascending channel. Contrarian traders believe the dollar may be close to a bottom despite the pessimistic outlook, particularly if market sentiment reaches extreme levels. Investors have historically sought refuge in gold and the dollar as safe havens during market sell-offs. As the stock market approaches euphoric highs and gold is already rallying, there may soon be a change in which the dollar and gold increase in tandem as market anxiety returns. Currency fluctuations significantly impact international investors. For example, Canadians who trade in U.S. dollars experience the effects of a sinking dollar on their portfolios. A declining currency reduces the real value of stock gains, even if the exchange rate remains favorable. Particularly in the United States, the majority of retail investors overlook this dynamic and focus solely on growing stock prices, disregarding the declining value of the dollar. Currency risk is typically only considered by more seasoned or international investors who understand that impressive portfolio performance in a declining currency may be misleading. Now, let's recall the interview.
There's no doubt the dollar has just been, it's probably one of the most hated assets. Everybody seems to hate it. And, people are like boycotting, the US to some regard with there's a lot of hurt feelings in nations, I think, because of the whole tariff stuff going on. And so people are moving away. I mean, the dollar looks oversold. It definitely has had a breakdown. It is trying to figure out if it's going to get some traction. It's in a downtrend at this point. From a long-term standpoint, when we look at it, it's a huge volatile channel, but it is still channeling to the upside. It kind of goes sideways, rallies, goes sideways, rallies, goes sideways in these massive ranges. And so I still think it's within its kind of overall patterns of how it's, how it's moving. It's getting to a point here where it needs to start to find some traction here soon. But overall, typically we see the stock market crash and sell off. Like a bear market, the dollar becomes a favored play and the dollar rallies. So we got the stock market showing signs that it's poking to new all-time highs. People are overly bullish. I believe the top is still coming in stocks. The dollar is the most hated. It's at major support. It's looking ready to bounce. Gold is warning us that the whole world is nervous. They keep moving into gold because they don't know what else to do. And gold's been a top performer. So there's a lot of these signs that are slowly painting this picture, but it is painful. Everything has to get stretched to the maxes. Everybody needs to get long stocks again. Everybody needs to bail on the dollar, and people who are going to move into gold, buy gold. And then we're going to see this huge reversion and everything changes direction. But the market has to stretch people to mental breaking points to put those positions on. And I believe we're getting there. I think the dollar is actually going to find a bottom here sooner than later, which goes against everyone else's opinion, which I'm a contrarian trader. I look for these extreme sentiment shifts. When everybody's hating, you should be starting to like something. I think we could see it. We've seen that quite a bit really over the past year and a half. I think they could both move higher. The stock market could start selling down. People get really nervous and they move to gold. We saw that in 2007. Gold took off while the stock market fell about 15%. And we also saw, I think, the dollar move up at the same time. So people moved to safety and the dollar firmed up. US dollar index firmed up. So it's totally possible going forward. And this is probably one of the reasons why gold has also taken off. The dollar has just been brutally hit over the last, really this year with the whole tariff talk. I mean, it definitely plays with international traders. I mean, I'm Canadian. I hold my portfolio in US dollars and I trade US indices. And it's not nice to see that currency going down in value. In the grand scheme of things for the Canadian dollar, it still has a nice value exchange in terms of the conversion. But yeah, people don't want to hold stocks in a currency that's falling in value. That's one thing that people try to navigate. There's only so much you can do. It's hard to navigate everything, the stock market, and deal with currency swings. You can only do so much, and at some point you just have to accept, not everything can be fully managed and protected. But yeah, people don't want to hold stocks if the currency that they're in is going down. But a lot of people, Danny, don't see it that way. Only very savvy investors who really get it and understand it. Most people just look at the stock prices and they're like, hey, my account's going to new highs. And they don't take it back a couple of layers and look at the underlying currency. And most people trading the US market are US traders, so they're not really looking to convert their currency anyway. So yes, people take it into account, but most of them don't.
A well-known trend that precedes significant downturns is reflected in the current market environment: rising gold prices, an oversold U.S. dollar, and a euphoric stock mood. Strong bullish patterns in precious metals, particularly gold and silver, indicate substantial upside potential. Gold is often viewed as a low volatility haven when economic uncertainty increases and the overall market is expected to correct. Despite their gains, gold miners remain at risk in a broader stock sell-off, while silver still appears poised for further rises. Even as the declining value of the dollar subtly reduces returns, U.S. retail investors continue to underestimate currency risk. If gold and the U.S. dollar both increased at the exact moment, may this indicate that market sentiment is about to change? In times of volatile correction, how should investors balance their exposure to mining companies and actual metals? We welcome your insights in the comments section below. If you found this content valuable, don't hesitate to give it a thumbs up and don't forget to subscribe to stay informed. Thank you for joining us on this journey.